Welcome to today's session on portfolio optimization, a cornerstone of modern investment strategy and a critical tool for any serious investor or financial analyst. In the world of investing, every decision involves a balance between risk and return. But rather than relying on instinct or guesswork, portfolio optimization provides a quantitative framework, a way to make informed, strategic decisions backed by logic and data. To understand this, let's think about the investment decision-making process as a structured top-down sequence. First, you decide how much capital to allocate between risky assets like stocks and risk-free assets like treasury bills. This is your capital allocation step. Next, within your risky allocation, you decide what types of assets to hold. Maybe stocks, maybe bonds, maybe commodities or foreign currencies if you're investing internationally. Finally, you select individual securities, a specific stock, a government bond, a tech ETF, etc. Today's focus is on the third stage, how to optimize your portfolio by carefully selecting the right mix of risky assets to balance return and risk. In finance, risk is more than a feeling, it's something we can measure. There are two key types of risk: systematic risk or market risk. This is the risk that comes from the entire market moving, say, during a global recession or financial crisis. No matter how diversified your portfolio is, you can't escape this. Idiosyncratic risk, also called firm-specific or diversifiable risk, this is risk that's tied to one specific company or asset. The good news? You can eliminate this through diversification. Now, here's a key idea. The market does not reward you for taking on diversifiable risk. If you choose to invest in a poorly governed company when there are better alternatives with similar profiles, you're not going to be compensated with higher returns. That's just inefficient investing. Portfolio optimization is about choosing the weights, the proportion of your capital to allocate to each asset. At its core, you're trying to answer, how can I combine different assets to achieve the best trade-off between expected return and risk? Let's begin with the return of a portfolio. Imagine you have a few assets, each with a known expected return. The return on the portfolio is just a weighted average of those returns. If you assign equal weight to each asset, you're giving them all the same level of importance in the portfolio. But you might prefer to overweight a stock with higher expected returns and lower risk. Mathematically, the portfolio return is the sum of each weight multiplied by its corresponding asset return. Risk is a bit trickier. You might think that the portfolio's volatility is just the weighted average of individual volatilities. It's not. Here's why. Risk depends on how assets move together. To compute portfolio variance, which is just the square of standard deviation, we need to take into account both individual variances and the covariances between assets. That's where the covariance matrix comes in. It's a matrix showing how each asset's return co-varies with every other asset. This is where diversification plays its magic. If some assets move in opposite directions, they cancel out risk. This is why combining assets can reduce portfolio volatility, even if the individual assets are volatile. Let's simplify things for a moment. Imagine you have n independent assets completely uncorrelated and you give them equal weights. Their expected return stays the same, but the variance drops by a factor of 1 over n. So as you add more assets, your portfolio becomes less risky, even though each asset has the same volatility. In the real world, assets are rarely perfectly uncorrelated, but even modest diversification can significantly reduce risk. If you plot expected return on the y-axis and standard deviation on the x-axis, you'll find that individual assets are points on the chart. Portfolios of these assets trace out curved paths, not straight lines. The curve captures all possible combinations of the assets at different weights. This curve is called the minimum variance frontier, the lowest possible risk for every given return. The top portion of this frontier is what we call the efficient frontier. That's where you want to be. This is the big idea introduced by Harry Markowitz. Use mathematical optimization to find the best possible mix of assets. The goal: minimize portfolio variance subject to achieving a target return, ensuring all weights sum to 1. Mathematically, it becomes a constrained optimization problem using Lagrange multipliers. Now we walk through the full optimization logic, from setting up the objective and constraints to forming the Lagrangian and solving the first-order conditions. This math might feel abstract, but it gives us precise, replicable ways to construct efficient portfolios. Let's now reintroduce the risk-free asset. What happens when you combine a risk-free asset with an optimal risky portfolio? You get a straight line starting from the risk-free rate, tangent to the efficient frontier. This line is called the capital allocation line, CAL. Its slope tells you the Sharpe ratio, how much return you're getting per unit of risk. Mathematically, expected portfolio return minus the risk-free rate, divided by the portfolio standard deviation. The point of tangency between the CAL and the efficient frontier is the tangency portfolio, the one with the highest Sharpe ratio. Let's break it down. Portfolio A has an expected return of 8.9% and a standard deviation of 11.45%, yielding a Sharpe ratio of 0.34. Portfolio B improves this with 9.5% return and a ratio of 0.38, but the optimal risky portfolio pushes it further, reaching a Sharpe ratio of 0.42 by combining assets to maximize efficiency. The goal is always to climb as far up the CAL as possible, getting the most return per unit of risk. Here's a surprising twist. What if you want even higher returns? You can borrow at the risk-free rate and invest more than 100% in the optimal risky portfolio. That's called leveraging, and it corresponds to moving beyond the tangency point along the CAL. This is possible because you're shorting the risk-free asset, essentially borrowing to amplify your returns and, of course, your risk. It's a powerful technique, but only makes sense once you've found the best risky portfolio to leverage. Take a moment to reflect not just on how you manage assets, but on how you balance risk and reward in every decision. Because whether in finance or life, optimization is ultimately about making smarter, more intentional choices.